to us. So my name's Nick Priest. I'm one of the partners at Downing. I'm head of strategic partnerships. We have Barbara and not other Barbara. We've got Barbara and Brody who are part of our London team. And the main man for today is Simon, who's in the middle of your screen. Simon Evan Cook, who over the last 25 years, through Fidelity, Rothschilds, and Gartmore. That is the best heckle I've ever had. By a country mile, actually.
It's like a Wookiee.
Yeah.
Is that you, Kevin?
That might be Kevin, yeah. He's multitasking, watching Star Wars at the same time. That's a great, even better multitask.
Sorry.
Welcome, Kevin. So over 25 years of experience in investment management through Fidelity, Rothschild, and Gartmore. And in 2006, joined Premier and built his reputation as an award-winning multi-asset manager with Premier, and joined us joined Downing in 2022 to launch and run the Downing Fox Funds, which is a strategy that has now over 250 million pounds worth of client money in it. And what we're going to do today, or what Simon's going to do today, I'm not going to take any credit for it. What Simon's going to do today is walk through what we see as the evolving face of an advisor CIP, and how we think that the Fox Funds and Simon's approach to the Fox Funds is perfectly positioned for an advisor in this current climate. What we think of the world of investment, how that all fits into what Simon is doing. So Simon, unless your Wi-Fi breaks out, it's over to you, and you're in charge. And yeah.
Thanks very much, Nick. And very nice to meet you all. And I believe Nick's told me that some of you are already supporting Fox, so that's great news. I really do appreciate that. I'm beaming to you live today from a Warrington hotel room because I'm on the PA Roadshow currently. So I'm about to present to you the presentation that I'm about to present in front of about 100 people downstairs in about an hour's time. So hopefully this is it's quite fresh for me, having done this a couple of times. But I genuinely think it's quite useful. It's something which shows firstly how Fox is very, very different. But it's also, I hope, going to give you a lot of food for thought about what might be in your clients' portfolios currently, because certainly the world has been moving towards one direction away from, I think, diversification. And I think potentially there's a risk of that reversing, but I won't steal too much of my own thunder. I'll crack into the presentation. So allow me to share my screen. And let me just make that a little bit bigger as well. Okay, so Nick, give me a thumbs up. You can see that okay? Great, okay. So the question I am asking today is, what is the minimum amount of work needed to manage a CIP, but that crucially still does right by your clients? And that is a crucial thing to say, because I completely agree with making a CIP as simple as possible, but no more simple than that, because if you make it too simple, then I think risks begin to creep in. So Nick's already done a little bit of introducing for me. I was at Premier Miton, that's where I built my reputation. These were the two funds of which I was lead manager over that time period, roughly sort of 10, 11 year run for these two funds. You can see the orange line is well above the blue line, the sector averages in both cases. And then since I joined Downing, these are the strategies since I joined. The orange lines there versus the kind of green lines and blue lines of the sector averages. So again, we've managed to achieve quite good things for our clients since joining Downing as well. So I'm told you can see this moving. If you don't know what this is, it's a perpetual motion machine. And I would suggest that a lot of financial advisors would love to have a CIP that runs like this, because it's a machine that doesn't require any input at all from anyone else or anything else. It just runs forever in a reliable fashion forever and ever. Now, I would suggest for a lot of advisors, again, but not everyone, some people like getting more involved, but for a lot of advisors, this low hassle machine would be the ideal way that a CIP would operate. Now, unfortunately, in the world of real machines, this machine is an impossibility. The laws of physics do not allow such a thing to happen. But the question is it possible to have this work in the financial world? And if it isn't possible, how close can you get to having a CIP that runs as reliably and low hassle as this? Now, I think a lot of advisors, not just advisors, but all sorts of product providers, think they've got already the sort of portfolio, the perpetual portfolio in place, and it looks something like this. This is the global stock market over the last 15 years, in this case represented by the Vanguard Global Tracker. As you can see, it's been incredibly reliable. This amounts to a 12% per year return. You've really hardly had any drawdowns over that period, so it's been highly reliable. And of course, if you're on this particular model, it's very, very cheap as well. It allows you to strip out a lot of decision makers, which allows you to strip out a lot of costs, and obviously clients in theory like that. But the question I guess I have is, has it gone too far? Have we stripped out too many decision makers, and have we created something approximating an accountability sink? So if you're not familiar with the term accountability sink, it's a situation that can arise, and it's arising more and more in the real world all over the place today, where effectively a system springs up, and that system kind of starts making decisions without any particular individual within that system necessarily making the decision themselves, or even particularly agreeing with that decision. Now, there's a really good example of this going back to '99, and it's the tale of KLM, the Dutch airline, and the Chinese ground squirrels. So back in '99, KLM had to import 440 of these squirrels from Beijing in China through Schiphol Airport in the Netherlands to effectively go on to Athens in Greece. But when they landed in Schiphol, they didn't have the right paperwork, and the ground staff basically got stuck with over 400 squirrels to deal with, which they're not particularly well set up to deal with, to look after. When they tried to ship them on to Athens, they couldn't do it because they didn't have the right paperwork. When they got in touch with China, they couldn't get the right paperwork, so they were stuck. When they asked senior management what to do, senior management said, "Not my problem, consult the rule book." They consulted the rule book. It seemed to not really be designed to deal with 400 squirrels. So for weeks, they went round in circles, and effectively in the end, the system ended up making the decision, and the decision was to shred 440 squirrels. Now, you can imagine being the CEO of KLM and waking up a couple of months later and seeing this headline that your airline has effectively gone into the squirrel shredding business. You wouldn't have been expecting that. I'm sure he wasn't even aware that it was going on. But I guess what I'm warning about here today is being careful that you don't get stuck in an accountability sink as well, where effectively it feels like everybody else should be making the decision, but actually nobody's making the decision. And you end up having to make a statement like the KLM spokesman said there, a bit of a dry corporate statement, the equivalent of which being that though we've done the right things in regulatory terms, actually we've ended up shredding your wealth, and for that we apologize. So I guess the question is, have we got any examples of a perpetual motion portfolio breaking down in the recent past? And we do. So going into 2020, this is what the bond market looked like. In this case, gilts. You had a very similar looking chart where for 15 years, if you'd done nothing other than just buy the cheapest gilt tracker, you got very reliable returns over that time period, to the point where in 2020, all sorts of products and CIPs and multi-asset funds basically had this permanent exposure hardwired into their portfolios in the assumption it would just carry on doing that forever. But obviously, as we all know, it didn't carry on doing that forever. That portfolio, or that machine, didn't just go, or didn't just stop. It went into reverse after that point, and quite violently so as well. Let me just get rid of that, and whatever that is. So that had obviously had serious repercussions, particularly if you were exposed to that. So what I've got here is what you might call the full do nothing model. And these are the Vanguard Life Strategy funds, which I think are excellent products, but they say very clearly what they are on the tin, which is that they are passive exposure to passive vehicles, and they won't change that around. But this was the experience. The lighter the color of the line, the more exposure to bonds that you had in that portfolio. And as you can see there, in terms of the drawdown in 22, the more bonds you had, the worse it was for you. And also the length of duration of staying underwater. So if you were in the 100% equity, i.e. the 0% bonds, It was a little bit painful, but nothing more than you'd expect from time to time in equities, about a year to break even from peak. But then as you add more bonds into the portfolio, you see that the duration of underperformance becomes longer, to the point where if you're in the 20% equity, 80% bonds, 3.5 years later, any client who bought in at that point is still underwater because of their exposure to that part of the portfolio. Now, we're talking about bonds here, and to a certain extent, that's in the past. What I'm warning about is the other part of a multi-asset portfolio currently, which is equities. And what I'm suggesting is that there is a serious risk that the same thing might well happen to equities. So you might want to kind of consider how that might look. So again, this is what equities look like over the last 15 years, highly reliable. So your question here is, has there been a precedent for this machine stopping in the past, or has it always done this? Has that always given you these really reliable stream of returns? Well, actually, again, you don't have to go back that far to see a point when this machine did break down, and it broke down for a long time. So this is going back to 2000, September 2000, so almost literally 25 years ago today. And as you can see, if you bought global equities for a client or anything like the global model in September 2000, you had to wait 10.5 years for that client to break even from that point. It was worse if you're in US equities. That was 11.5 years for US equities to break even from that point. Slightly less bad in UK equities, 5 years. UK mid-cap slightly better, 3.5 years. And right at the end of where you got the best experience, an active UK small cap value fund. Now, I'm highlighting this to sort of ask the question again of how similar are conditions today to what we saw in 2000, and therefore should we be worried about this machine, which so many of us use, breaking down again today? Because those conditions in 2000, I was there, I was quite early on in my career, but I remember everybody hated everything that was UK, that was small cap, that was value. And you look how well that did from there, from that point of being the thing that everybody hated and nobody was buying. And everybody loved global mega caps. They loved US mega caps. They loved US growth, because this was the time of the internet coming around, a brand new technology, which had got everyone very excited about how that was going to change the future. And I think you can agree there's quite a lot there that rhymes with where we are today in terms of market sentiment. So are there any other warning lights flashing? Is there a kind of big red light about to appear on the dashboard of your global equity engine? Well, I think there are quite a few to look at. So if you look at recent returns, so these are rolling 15-year returns. So these bars represent the 15 years ending in the year on the chart. And as you can see here, it goes in these cycles and patterns. And the worrying thing here is US equities have outperformed and created excess returns to such an extent that the last time you saw them do this was 99, 2000, just before that period when they went and created very poor returns after that. So this is grounds for concern, I believe. I've highlighted there 1987. On this series here, that's the worst period. So that is a 15-year period ending 1987 and therefore starting in 1972. I've highlighted that because, again, there are a lot of similarities between 1972 and now, which we'll show you on the next chart. So one of the problems in 99 was within the US equity market, there was a high concentration in its biggest companies. You can see that there on the chart, we've circled it. What I think is of more concern is that today, the US market is more concentrated in its biggest companies than even it was back in 2000. So if those big companies have a problem, that problem will have a bigger impact on the US equity market than it did even in 2000 before that lost decade. And as you can see here, the last time the US equity market was this concentrated was 1972. You may have heard people talk about the Nifty 50 before. This was that time, and it heralded one of the worst ever periods for US and therefore global stock market performance. Let's look at now at the global tracker. So rather than the US market, we're looking at the global market. And again, here, I think it's quite worrying. This is how much exposure you have to US equities within that. Part of the big problem in 2000 was the global market was heavily exposed to US equities, but then it was only 50% exposed. Today, we are at 75% exposure to US equities in a global tracker. So again, if the US market has a problem like it did in 2000, it may well be even bigger than it was in 2000 and therefore even longer for your clients to break even. Again, it looks a lot more like 1972, which was the last time the US was this big in terms of its global stock market presence. And you can see it went into recession for a long time after that. So we have here also valuations. So we're looking at the CAPE, which is the long-term valuation of US equities, a very reliable measure of whether it is expensive or cheap. I mean, the somewhat good news here is it is at least less expensive than it was in 99, 2000. But the bad news is that it is literally more expensive than any other time in history, including 1929, which was just before the great stock market crash and before the Great Depression as well. So again, this is not a particularly encouraging sign for US equities. What you can do is you can then translate those valuations and look on a mean reversion basis what that might mean for future returns going forward. And we've set those out here. And while it might seem quite doom and gloom what I've been talking about here, really what I'm trying to say is the only problem is in large caps, and particularly in the US. If you can find a way of getting away from those markets, then over the next 10 years, these annualized returns look actually very attractive. It's only when you are stuck in those parts of the market that have done so well that they've become expensive that it's a problem. So those are the two things to be looking out for. I think it's geographical exposure, but it's also market cap exposure. So let's have a look at some of the kind of common models within the product world that you might see. So on the left here, we've got what you'd call the global model. So this is the global stock index of the global tracker, but increasingly you will find a lot of products are based on this. They'll take this basis and then they'll basically move slightly from this. So Scottish Widows have quite in a high profile while just moved to this way of doing things after years of not doing it this way. The alternative is what's called the classic model. And this is, if you look at the Vanguard Life Strategy funds, to give them their dues, this is the model they're on. And what the classic model means is you've got a home bias built in. Because Vanguard only sell this to UK advisors and clients, they built in a 25% exposure to UK equities, which means it does have more balance within that. So it only has 50% exposure to North America, which I would argue is still high, but it's at least less high than many of the other popular passive products. You might have a lot of them in your portfolio, which may well be on the global model. So if you're doing CIP work and you look at different options, this is a key question to ask. Are you on the global model or are you on the classic model? Downing Fox is very much more on the classic model. We've got that home bias like Vanguard built in, but we've got it even more that way. We have about a third of the portfolio exposed to North American equities currently. That's largely because our active fund managers are moving away from that because of the valuation risk they're seeing there. So when a lot of advisors are buying Fox, this is one of the reasons. It gives them great diversification versus those cheaper passive products, and again can help to mitigate against that risk of having too much exposure to US equities. So back to this chart here, it's not just geography as well. If you look at the size effect here, so on the right hand side you see it's US large cap and US large cap growth that look the most compromised. On the left, the areas that look like they've got the lowest risk from overvaluation and also the highest potential to make future returns are small caps. And again, it's interesting to look at where you find a lot of products currently. So if you look at a global tracker, that is basically a mega cap, large cap product. So you will see they have well over 80% exposure to larger mega caps, with the rest filled up with probably quite large mid caps. In this case, the Vanguard Life Strategy funds are exactly the same. They've got a little bit of exposure to small caps, but really not very much at all. It's basically a large and mega cap product, which is exactly what it should be, given they're trying to make the costs as low as possible. When you look at what we've got in Fox, we have a much bigger spread across all of those different areas. So we're not just focused on one of them, but we have got a lot of diversification across all of those areas. So if small and mid caps do well, then we should be able to benefit from that. But also we're benefiting a lot, even now, from the lower volatility that's giving us versus a global tracker. So again, when a lot of advisors have been buying us, they like the fact that this diversifies them, but also if the next 10 years is about small caps, not mega caps, you've got an amazing stream of returns that we're already tapped into. So let's go back to this chart now. So I've added on to this chart of the Vanguard Life Strategy experience over the last sort of 3.5 years or so, the Downing Fox model strategies. to show what we've done and compare that to it. If we look at our 100% equity first of all, so that's our darkest orange line, we had a smaller drawdown than Vanguard in 2022, and it took us less time to break even again. But what you will see is that since 22, when it's been the story of the mega caps and US exceptionalism again, the Vanguard 100% equity has caught up and overtaken us. We're quite comfortable with this. We know the reasons for it. We're never going to have the same level of exposure to the US and to mega caps that Vanguard does. We're just very different products in that way. But I think the bigger difference comes when you compare our funds, which do hold bonds, because all three of our bond holding funds, so our mixed asset funds, took just 3 months to get back to peak from that time period. So advisors holding Fox at this time did not have anywhere near the problems that a lot of your peers may have done, because we managed to sort of see the risk of that bond machine breaking down and mitigate it. So our 40% equity option, 60% bonds is the lightest orange line here. And you can see there that had the lowest drawdown in 22. We're well aware of how important that is to advisors to make sure your most cautious clients get the most cautious experience. And that's what we achieved for them in 2022. That star there, by the way, is when the Downing Fox funds themselves actually launched. I say this because the elephant in the room is when you start measuring the Fox performance, you can see you've got a lot of recovery against our competitors. So we look quite boring, to be honest, when you look at our performance over this time period. Again, I'm very comfortable with that, given that it has been conditions which really don't suit what we do at all. In fact, they're the absolute opposite of the conditions which suit us. So average is kind of fine, given that we've been playing away from home, as it were. So we call our model the whiskey and water model. There are a few good reasons for that. So this is basically what the Downing Fox funds look like. Like the Vanguard Life Strategy funds, there are 40, 60, 80, 100% options. The whiskey, if you like, the orange part is our equity exposure. The big difference between us and Vanguard and a lot of other people is that is 100% actively managed funds. That's all that's in there are what we consider to be the greatest fund managers we can currently find at reasonable prices. The blue part, the water to our whiskey, is passively managed bond vehicles, but that we actively manage that risk and to prevent risks from building up so we can avoid a car crash in the bond part of the world. So the whole thing is designed so that we can move away from risks building up. So either us doing that in the blue part of it, or in the orange part, it's the active fund managers who are stock by stock moving away from expensive companies and moving away to cheaper companies which have higher potential returns ahead of them. This has been the performance of those two components since I joined Downing. You can see the dark blue line there is our defence component, our water. And the key point to note is versus gilts, the lighter blue line at the bottom. We did a good job in 22. We actually managed to make money for clients in our most cautious strategy in 2022. That was because we saw that there was a massive risk building in the bonds part of the world. And so we were 100% cash at this point, or very short duration bonds with some dollar exposure as well. But since then, we have moved back into bonds after the bond market sold off, because we do see that there's more value in some defensive exposure there as well. So we are strategically managing that for you. Another part of the reason that we call this the water within the whiskey is that we actually do this part of the fund for free. So when you look at the OCFs, the more water in your glass, as it were, or defense in your fund, the cheaper the OCF gets as well. You can see also there that our equities have outperformed the global average over that time too. So we like to think we're doing a good job on both parts of the portfolio. So I agree with Einstein here. It's not a controversial thing to say that you agree with Einstein, but you should make something as simple as possible, but no simpler. And I think that's the case with the CIP as well. I think a simple CIP is a beautiful thing, but you don't want to go too far in that. What we've got here is a case study of one of our clients. I've known them for a very long time, got a good history of working with them. It's a financial advisor called Johnston Financial up in Edinburgh. This basically on the left is their entire CIP. So they have two building blocks within that. They have a cautious fund, which is run on our Fox 40 model and has been since April 22. And they have their own growth fund as well, which is run on our Fox 80 model. And as you can see on the right-hand side here, both of those funds have performed in the way that I think an advisor would like to see that type of portfolio perform, which is to say the cautious fund has performed cautiously. In fact, this fund, the Johnston Cautious Portfolio, is the least volatile fund over our tenure in the 20 to 60 sector. And then the growth fund has also, I think, performed relatively well, quite defensively too, but importantly has made money. And both of them have made money when markets are rising again, which obviously is a very important thing to be able to do. How Johnston Financial use this is it's very simple for their advisors to use, because it just takes all of their clients, no matter what their level of wealth, they all get effectively the same building blocks. It just varies by their risk profile. So the most cautious clients will be 100% in the cautious fund. Their most sort of risk-taking clients will be 100% in the growth fund. But in practice, most of their clients will sit somewhere between those two levels, and they'll simply get a blend of those two portfolios put together. And that is really very simple for them to run, and it's worked. It's been very reliable. It's allowed Johnston Financial to go on with building their business, get more clients in, because they're not having to spend too much time fighting fires or looking after their CIP. So another thing to consider as well, I think, when you're looking at CIP is the structure of that, particularly is it unitized or non-unitized? A lot of advisors across the country will do something that you might call a DIY portfolio, or maybe they use MPS or DFM. Basically, within that, a client is going to have direct exposure to 20 different funds, or whatever the number might be, but it's normally around about 20. That means that you've really, if you're doing the DIY model, you've got to stay on top of those 20 funds. Or if you're MPS, maybe you should be on top of them, but the MPS provider is doing that. But administratively, it's a bit more difficult as well. But there are more and more alternatives popping up in the unitized world as well, which is, if you take the example of what you'd call unitized MPS, where they're taking blocks of these funds. Let's say the dark blue blocks are UK equity funds, and maybe the multicolored blocks are bond funds, and they wrap them up within one unitized portfolio each. And so you've now got 4 building blocks rather than 20. For tax purposes, particularly, that's obviously more pertinent for high net worth clients who are outside of a tax wrapper, because there's much less chance of a CGT event happening here if you've only got 4 building blocks to consider rather than 20. But Fox itself is a fund of funds, which means that our entire portfolio is wrapped up within one fund. So again, I think that's a lot simpler for people to keep a track of, rather than looking at lots of different things together. We're also looking at the Fox MPS as well. So if this is of interest to you, give us a shout afterwards. But basically, we would have 2 building blocks within that. And the theory being that we go back to that whiskey and water model, where effectively you would just need to understand 2 things: how much growth the client needs, how much defense, and then it just becomes as simple as mixing those 2 components together. It's a very reliable way of structuring portfolios. But the trouble with simplicity, of course, is that some people don't like simplicity. Some people actually like complexity, and clients particularly like to see a little bit of complexity in a portfolio, because if they just see one line of stock here, as you would see with a fund of funds, it doesn't feel like it's diversified. It doesn't feel like a great deal of work has gone into selecting that fund. Whereas actually, when you look at an MPS, you see here a much broader range of holdings. So the client does feel diversified, and the client does feel like there's a lot of work being done under the hood, which maybe represents the work that's actually being done. But we've solved that at Downing. We have got a look-through reporting tool if you want to go and see, for those of you who do hold the Fox funds, what effectively your client holds within that. You can go in there and you can put in their holdings in one of our funds, or if they hold two or three of them, and it will give you a kind of consolidated report like this. And again, if you put this down in front of a client rather than just one line of stock, they're going to feel like a lot more work is being done, and they're a lot more diversified, which of course is the truth, because there is a lot of work going on underneath the surface with the Fox funds, despite how simple they look to the outsider. So these are the funds themselves. When you look at our 2 components, we just run these 2 components. So the 100% equity holds exactly the same funds as the 60, the 80 and the 40, just in different proportions. And we think that is a very appropriate and reliable way to run money for advisors. The thing you'll note here is that if you look down this list of funds, there should, I'd imagine, be a lot of funds in there that you don't recognise or haven't seen before. Most of our holdings are not available on a lot of platforms or available on MPS platforms, what we're really looking for are the very, very best in class fund managers. That's all we're interested in finding. And quite often they're in boutiques or they're newer funds where a team has spun out of a bigger company and started up their own place. And because they're starting up as well, that's how we've managed to get the OCFs for a fully actively managed fund of funds as low as they are, because we're getting founders deals on these, which reduces the OCS we're having to pay them. So if you're looking across the CIP, I think there's, when I've been talking to clients on the roadshow this week, we've sort of looked at, if you take it from the client on the left-hand side and look at the different levels of decisions that are needed for them to effectively get into the market, you've got asset allocation, which might be risk profiling, and then deciding whether they're in a 60-40 or an 80-20. It might then be asset class or regional selection. So how much in US or Europe, or how much in long duration bonds versus short duration bonds. And then stock selection. So that's picking the individual companies and individual bonds as well. Now, what we're going to do is run through a few of the options advisors have here, where you've got more work at the top and less work at the bottom. At the top here, I guess you'd call it the fully DIY model, where you do everything. I think this is quite uncommon now, because really I haven't met many advisors who actually select the stocks themselves. So today, a DIY portfolio looks a lot more like this, where you, the advisor, do the risk profiling and then decide on the asset allocation. And then the advisor as well does the asset class selection and the bond selection within that, but then maybe uses a selection of active funds to actually pick the stocks for them at the end of that. A close equivalent would be you do the exactly the same level of work, but then you get somebody else will effectively use passive funds to populate that view as well. And again, I think in this model, you've got enough decision makers in there, because you are at least looking at the risks that might be building up at an asset class selection, and you've got enough choice in the passive world maybe to pick vehicles that represent that. The next one I would call the classic multi-asset model, the go anywhere fund. Now, in theory, this type of fund should be less work for you as an advisor, because the multi-asset fund manager is looking at all the risks out there and then moving the risk profile of that fund around depending on what they're seeing in markets. I think in practice, what they're quite often doing is stepping on your toes as an advisor, because if they're moving the risk profile of that fund around, and let's say, for example, you've got a client who is approaching retirement and therefore you are reducing their risk, if the fund manager is raising that risk at the same time, there's a risk that potentially they're undoing the work that you've been doing. So I think actually conversely, that one can end up in more work. Then there's this model here where, again, you do the risk profiling, but then there's a very firm line drawn between you and then the work that the whoever you're outsourcing that to, the multi-asset manager, does then, where they pick the asset class, the region, they pick the bond selection, but then they also do the stock selection as well. Alternatively, you can do it the same again, where you are doing the asset allocation and the risk profile, but then you hand that over to a fully passive offering here. Now, it's this last one that I have some concerns about, because when you look at that, you can see that effectively you have stripped out the investment decision makers. Anything beyond risk profiling is now just kind of left on autopilot. And it's this model that I'm concerned that has done so well for 15 years that there's a risk that it doesn't do very well at all for the next 10 to 15 years because of just how well it's done. Now, the Fox model is this one here. We've drawn a very firm line, you can see it in the names of the funds, between where we'll stop doing work and where you start doing the work. And I think it's appropriate for you to pick the risk profile of the fund, and then it's appropriate for us to fulfill that for you. And we know that that's our role, and that's exactly what we do at Downing Fox. So just to summarize what I've been talking about there, I mean, the question to be asking when you look through your selection of funds you've got for your clients is, who's driving this thing? Is there someone actually looking at the full suite of risks that your clients might be facing? Hopefully I've shown you that I believe that in certain areas of the markets there are warning lights flashing, and it's quite common areas of the markets which a lot of people are currently exposed. And then finally, simplicity in your CIP is a very, very good thing, but just to ensure that it's not so simple that you've kind of created that accountability sink where effectively nobody's now making a decision, the system is sort of deciding for itself. So that's always our tagline. You'll see that plastered everywhere you see us, that we're trying to be simple for you to use, trying to be reliable, and also easy for you and your clients to use Downing Fox. And if you're interested in what we've been talking about here today, we've got more details on that case study about how Johnston Financial used Fox within their CIP and the benefits that's given them. And then I've written the quarterly letter, which is on that American exceptionalism theme and the risks building in the do nothing model. So again, if you want to have a look at those, we'll send those on to you as well afterwards, so you can have a read at those further resources. But I will pause there and ask if anyone's got any questions on anything. No questions coming in, just a stunned silence.
Julian has told us that she has no questions.
There is one that's just coming.
There's one coming from Kevin. Do you revise the costs on a regular basis as you build the funds?
Well, what we're doing is, because we are getting more assets under management, so Nick undersold us earlier. I think that's the first time he's ever done that. We're about 315 million under management now, and the more assets we get, the more bargaining power we get with the fund managers we're buying. We've also got a very good reputation for being early investors in funds, and they're new funds, by the way, not new fund managers. So these are quite often very, very experienced investors who just need to get the fund up and running. So yeah, we're finding that our OCFs come down over time. As we scale, certainly I would hope that the direction of travel is for Fox to get cheaper, not more expensive. And of course, what we haven't mentioned is that if we've got significant early backers of the Fox funds, we have still got our own founder share class available as well, which obviously you can talk to Nick about. But if we get a significant commitment, we can bring those OCFs down for you into the kind of early bird share class, which would be for all of your clients for life. So that's worth having a look at. If we don't have any other questions, I did have one last little kind of selection of things to run through. It's competitor analysis we look at. I think it's quite good at looking at how Fox has worked in practice. So maybe I'll just do that if you'll indulge me for another couple of minutes.
I might interrupt you, Simon. You crack on. I might interrupt you because I think Kevin's got follow up on that.
Well, let's go with Kevin's question first. That's the most important thing.
I just saw he was typing. That's also. I might be putting you on the spot now, Kevin. Sorry.
He's going to have to make up a question.
pressure on.
Oh, well, you're welcome.
I was going to say thank you. Thanks, Kevin. Yeah, so all yours, Simon.
Yeah, okay, I'll share this. Let me bring this up and it'll hopefully work. So let's go back to the beginning on this one. So we've just got, this is basically Morningstar. It's not our data, it's Morningstar's data. I don't know if you're familiar with this, but this is a Morningstar style box. And what we've got here is us compared to some of the kind of common passive equivalents. The Morningstar style box works by, if you're left or right, left your value, if you're right, your growth. But if you're higher, you are into mega caps. If you're lower down, you're into small caps. And this is quite a useful chart because in terms of us being different to everyone else, it's quite stark. We are that orange dot in the middle there, telling you that we are balanced by style. That's very important about what we do. We don't want to be taking you on too wild a ride by being all growth or all value. That's a permanent feature of Fox. But we also think it's sensible to be in that middle box where you've got a much greater diversification and ability to make higher returns over the longer term. You can see that most of our peer group are up in that top box. And in fact, when I look across almost all of our competitors, everybody is sat up at the top currently. There are very few options which take you down where we're taking you. The other thing to note as well, as much as you only see one orange dot on that chart, there are 4 orange dots. They're all just in exactly the same position. And this is the point of what we do about managing the risk for you. It's why we've always got that same portfolio across the 4 funds, is it means that it's very precise and it becomes a much more of a precision tool for you to use with your clients. Whereas you can see even some of the big names up there with all of their might have got a slightly random arrangement of dots where they're in slightly different positions across their risk range. When you look at how that's translated into returns, so you can see we're on the left-hand side there, and this is over the time since I joined Downing to the end of July. We've got quite a tight level of returns there, so we've generally outperformed, particularly in the lower equity areas. You can see there that where we have lost out, it's been on the equity side versus the dark green is Vanguard, for example. But the spread of differences Vanguard have got versus what we've got, I think has made it quite unhelpful for advisors over the last few years. We have not had that problem. And what's particularly interesting is the drawdown chart. So this is the worst experience you've had over that time period of holding any of these funds within any of these ranges. And you can see there, Fox, everything has been in the right order, and that's so important. So the most cautious fund on the left had the most cautious experience and the lowest drawdown. When you compare that to Vanguard, their most cautious fund had the steepest drawdown. And you can see that's quite common across a lot of these passive fund ranges, which I think is a bit of a flaw in the model. I think another way to look at these is to look at the risk reward trade-off. So again, we've got a very tight line here because of the way we run things. And you can see here, again, this makes it very much more predictable. Fidelities are kind of in the right order, but it's maybe not quite as tight a gathering. But when you look at some of the other ranges, you will see that those dots can start to look even a little bit random. They're not in a straight line where you've had one of the portfolios performing out of line with the other ones because they're not running them on a very modular, similar basis. So this is what we take very seriously. And again, when you look at Vanguard there versus us, you can see that massive dispersion between their fund range, which is again what we're trying to avoid for you as holders of the Fox funds, and we're actively trying to avoid that. Whereas Vanguard have kind of set out their stall and told you what they're going to do, and they will do that, which I think is creditable. But they do not have a decision maker in there trying to manage the journey for you. So that was what I wanted to show you anyway. So I'll stop sharing that. If there are any more questions, do fire them in now. If not, I'll hand back to Nick to wrap up.
I think we're good with questions. So firstly, thanks, Simon, for that, and Mo, and for everybody on the call. Really appreciate you taking the time out to listen to it. Hopefully that was interesting, informative. We're really, really keen to talk to you in more detail. If Simon, as he always does, has piqued your interest, we're keen to take the conversation further. We'll be in touch in any event, because at the very least, we want to furnish you with some CPD certificates to reward you for taking the time out with us today. So, and we'll be in touch with that on that basis. But yeah, look, thanks very much. And Mo, thanks very much for organising this for us as well. So I really appreciate the time out. And perhaps we could speak again soon, just to see what we can do to follow up from here.
Great. Thanks, Simon. Thanks, Nick. Thanks, Brodie, Barbara. Appreciate that. Yeah. And yeah, we'll send the recording out. Any slides or anything, please send those to us. We can share with advisors that weren't able to attend. That'd be fantastic.
Right, we'll do that. Yeah, absolutely. Lovely. Thanks very much. Have a nice day.
Great. Thank you very much for your time, everyone.
Thank you.
Bye. Bye now.